Hey everybody, welcome to Chapter 10. Chapter 10 talks more about liabilities. Liabilities, if you remember correctly, is money that we owe to other people, or so debts that we have to pay. Anyway, so here's the learning objectives. I'll let you read through those on your own. And then the preview, the way they kind of break out learning objectives by section. All right, so liabilities are broken into two categories, just like we talked about our assets being either current assets or planned assets, or sometimes we call them non-current or long-term assets. So with liabilities, we have current and we have long-term or non-current liabilities. A current liability is a liability that is going to be paid from our existing assets or through the creation of other current liabilities. Meaning we'll use our cash usually to pay those off, and if we don't, then we will refinance them with another piece of debt that will pay off the first one. And the biggie there, number two, is that the company will pay the debt within 1 year or the operating cycle, whichever is longer. So these are short-term in nature. They don't really go into it. There's a list here at the bottom that says what current liabilities include. Accounts payable is just what it sounds like. They usually arise out of business transactions where somebody says, here's the stuff I'm selling to you, you can pay me, you have 30 days to pay me. And so the amount you owe in the next short while is an account payable. There's not usually any interest on that. It's just sort of an informal arrangement to pay somebody. All the rest of the current liabilities covered here are more formal, where you write up a note or that arise from some type of other transaction involving taxes or other things, and you'll see as we go through them. So the first is a note payable. That's usually a written note. It usually requires the borrower to pay interest, and they're usually due within a year because we consider them to be short term. A note payable that extends beyond 1 year wouldn't be considered a current liability. It would be a long-term or non-current liability. So here's an example of one. First National Bank agrees to lend $100,000 on September 1st if Cole Williams signs a $100,000 12% 4-month note maturing on January 1st. When the company issues an interest-bearing note, the amount of the assets it receives generally equals the note's face value. So the transaction that will occur is that from our perspective, the company's perspective, is our cash will increase or be debited $100,000, and our note payable will increase or be credited $100,000. Cole Williams Company prepares financial statements annually. It makes an adjusting entry on December 31st to recognize the interest. So if we took the loan September 1st, then by December 31st, we'll have accrued September, October, November, and December's interest. So the interest expense will be $4,000. We find that by multiplying the face amount times the rate times the time, in this case 4/12 for 4 months. So on a 12% note, that's $4,000. And we create an interest payable. That allows us to record the expense and then a liability showing we owe that. Then on January 1st, when we pay the note, we will reduce the note payable. Remember, that's a liability, so by debiting that account, it goes away and we no longer have a note payable. We'll also have to debit the interest payable, and then our cash will go down by the total amount, or $104,000. So sales tax payable, that occurs because the government wants their cut, right? So every time you sell something that's taxable, then you're going to have a sales tax payable that comes about just by selling that. Remember, what happens is the company that sells stuff collects the tax from the customer, and then usually at the end of the month or the quarter, depending on their sales volume, they will file a form with the state government and they will pay the taxes that they've collected from the customer. So here's an example on March 25th, register readings for Cooley Grocery Store sales of $10,000 and sales taxes of $600. So that means they collected $10,600 from the customers. So the journal entry will be the cash goes up by $10,600, sales revenue gets credited $10,000, and sales tax payable, a liability account, gets credited $600. Some cash registers don't do it separately, which is kind of a hassle. So instead what they do is you say, okay, we had $10,600. We have to figure out how much of that is sales tax. And so the way you do that is you just figure out a total cash increase of $10,600, sales revenue is $10,000, and then you multiply 10,000, so I'm sorry, sales revenue is $10,000. You find that by taking the total amount you collected and dividing it by 1.06, which represents 100% plus 6% for the sales tax. And then our sales tax payable would be the other 600. So sometimes the problems will have you break it out like that, other times it'll be given to you. And then what it doesn't show you here is that when you pay the sales tax to the state, what you do is you debit the sales tax payable account and credit your cash because you're paying that money out to the state. Unearned revenue is another type of current liability that comes up whenever we collect money that we have not yet earned. So for example, I own a business that happens all the time. People pay me for a year in advance for renting a storage unit. When I collect that money, it's not all mine. I have the cash, but I owe the customer a year's worth of service. And so what I do is I create a liability called unearned revenue, and then each month I record that I've earned a portion of that revenue and reduce the amount of liability. Here's an example. Superior University sells 10,000 season football tickets, $50 each. I wish I could buy season tickets to my local university for $50 a piece, but I can't. The entry for the sale of the season tickets is cash goes up by $500,000 and unearned ticket revenue goes up by $500,000. Then, as each game is completed, Superior records the earning of the revenue by reducing or debiting the unearned ticket revenue account and by recording it as revenue at that time. There's also what's called current maturities of long-term debt. This is just long-term debt always has a part of it that's going to be due in the next year. So we want to show that as current. That's important to someone looking at our balance sheet because it helps them understand that some of our long-term debt is going to be due in the next year. So no adjusting entry required. Wendy Construction uses a 5-year interest-bearing $25,000 note. The note specifies that each January 1st, starting January 1st, 2012, Wendy should pay $5,000 of the note. When the company prepares financial statements on December 31st, 2011, what amount should be reported as a current liability? What amount should be reported as a long-term liability? So the amount that's due within the next year, or $5,000, will be a current liability, and the amount that's not due until next year or beyond, or $20,000, will be reported as a long-term liability. Payroll and payroll taxes, same thing, right, as all these other concepts. When we pay our employees, when our employees work, they earn money, and if we haven't yet paid them, then we owe them that money. That creates a payroll liability. And also, whenever we pay people, we have to hold out taxes, usually some that they've paid and some that we've paid. And then at some point, usually quarterly or sometimes monthly, we have to pay that amount to the government. And so until those are paid, it creates a liability. You'll see right here, determining the payroll involves computing 3 amounts: gross earnings, that's how much the person has earned, that's usually their salary or their wage rate times the number of hours they've worked, payroll deductions, and then their net pay. So here's an example. Cargo Corporation records its payroll for the week of March 7th as follows. The salaries and wages expense is $100,000. FICA, that's Social Security tax payable, $76.50. Federal income tax payable, $21,864. State income tax payable, $29,22. And salaries and wages payable, $67,564. Then when they actually pay the payroll on March 7th, the salaries and wages payable goes down, right? They're paying that. And their cash goes down by the same amount. Then, again, what it doesn't show you is in the future when they pay the government those taxes that they've held out, what they'll do is they'll debit those tax accounts or the payable accounts and credit cash. The most common types of taxes you'll see is FICA, which is Social Security, federal unemployment tax, and state unemployment tax. So here's based on cargo company's payroll. The company would record the employer's expense and liability for these payroll taxes as follows. And there they are. All right, so that's it on the short-term or current liabilities. So now we're going to move on to longer-term liabilities. The first and probably the most, well, I don't know if it's the most complicated, but there's a new way of thinking involved here that it's challenging for some people. So first of all, you need to know what a bond is. A bond is just a note payable, okay? They're long-term in nature, and they're usually done by corporations, universities, and governmental agencies. They'll borrow money, and then what makes them different from just borrowing, though, like usually when we think of borrowing, we go to a bank or someone. With a bond, what we're doing is usually it's when we want to borrow a whole bunch of money, and rather than try to borrow it from one source, we sell investments to investors, and they're loaning us the money. So if we want to borrow $100 million, maybe what we do is we go to a brokerage firm and say we want to borrow $100 million, and the brokerage firm agrees to sell bonds to all of its customers, and they can buy as little as $1,000, which means they're loaning the business $1,000, and then a whole bunch of customers, each loaning the business $1,000, $10,000, maybe even $100,000, adds up until we as a business have borrowed a whole $100 million, and all of that group of people out there that have borrowed from us are what's called bondholders, and we pay interest out to them. So that's kind of what a bond is, and who bondholders are. They're investors who are loaning money to either a corporation or a university or a governmental agency typically. So there's a few different types of bonds. There's what's called a secured bond versus an unsecured bond. So a secured bond is a bond that has some asset securing it. So when we borrow the money, say to build a new building, with a secured bond, what we're saying is if we can't pay you back, then the building will be liquidated to pay you back. Whereas an unsecured bond says, no, there's no asset underlying the bond. We're just paying it from our ability to pay. And if something happens and we can't pay, there's no asset there. So you could guess, just from their name, secured is going to be safer than unsecured. A convertible bond is a bond that we can convert into stock. So remember, a bond is a little different. So if we're the one that's loaning the money, we can say, hey, instead of you paying us back, we just want to take an ownership stake in your company equal to the amount that we had loaned to you. That's what a convertible bond allows. And then a callable bond is one that allows the borrower of the money the opportunity to pay that bond off early. So if that happens a lot when the company has borrowed money and then interest rates drop, what they'll do is they'll issue a new bond at the lower interest rate and use the proceeds of that to pay off the old bond. Or sometimes they just are able to make more money than they thought, and so they'll pay the bond off early. Just like you and me, when we get a little extra money, we like to pay down our debts. We don't want to have to wait until they're due. We want to be able to pay them off early. That's what callable means. All right. So there's a couple things that happen when a company borrows money using a bond. First of all, a bond certificate is created. I will tell you that nowadays you don't usually get a physical certificate. Instead, the bond certificate is held in an account electronically, but there's still a bond certificate, and it tells all the information about the bond, including who the parties are involved, who's borrowing money from whom, the face value, the maturity date, and the contractual interest rate, and we'll look a little bit more at those in a minute. So here's a picture of a corporate bond certificate. Tells you the issuer of the bond. That's who's borrowing the money. It tells you the contractual interest rate over there on the right. That's how much interest will be paid. You can't get bonds paying that right now, just so you know. They're more like 2%. That'd be pretty awesome, actually, if you get 11.875. It shows you a face value or par value of $5,000. And then there's some terms down there below. So this is what a bond looks like. All right, so here's where things start to get a little confusing sometimes. Because bonds, even though they're a loan, they are an investment as well, and that makes them transferable. And that means that if I purchase or invest in a bond, in other words, if I loan money to a business, and then I decide, hey, you know what, I really need this cash, I can go out and find someone else who's willing to be the bondholder, and I can sell my bond to them. The thing is what's a fair price for that bond? And a couple things impact the value of a bond. The first is the face value, right? When that bond becomes mature, how much is the holder of the bond going to get paid? The second thing is the length of time until the amount is received. It's different if I'm going to get $10,000 for that bond in 6 months, or if I'm going to get $10,000 for that bond in 30 years. That's going to impact how much I might be willing to pay for the bond. And the third is what's called the market rate of interest. So I don't know why they don't have the fourth, which is the stated rate or the guaranteed rate that's on the bond. But it's sort of that relationship between how much the bond is paying in interest and how much market interest is if I were to go borrow the money somewhere else today. If you think about it, if somebody had a bond that had a $10,000 face value and was paying 9% interest, and they wanted to sell it to somebody else, well, the things that the person would consider when they were trying to figure out how much to pay for that bond would be, well, how much money am I going to get back, and how long is it going to be before I get that money back, and is the amount of interest, the 9% it's paying, good or bad? In other words, if I were to go buy a brand new bond being issued today from somebody, would I get 9%, or would I get better than that, or would I get worse than that? If the best I could get today was 6%, then I might be willing to pay more for a bond that's paying 9%. Conversely, if I could get 12%, then I wouldn't want to pay full price for a bond that's only paying 9%. So these are the things that matter when we're trying to figure out the market value of a bond. And there's a little yellow box at the bottom that says the process of finding the present value is referred to as discounting. So let's talk about that. So here's an example. Assume the Acropolis Company on January 1st issues $100,000 of 9% bonds due in 5 years with interest payable annually at the year end. So this bond, $100,000, is going to pay out 9% or $9,000 per year, and at the end of 5 years it's going to pay back the full $100,000 in principal. So the question is, what is the market value of this bond? Because we know that it's worth $100,000 5 years from now plus $9,000 a year for the next 5 years. So we have to use something that we're not going to get real in depth with in this chapter called present value. And present value just means, it's kind of like saying, hey, if I'm willing to give you $100,000 5 years from now, what's that worth in today's dollars? What's the promise of $100,000 5 years from now worth in today's dollars? And what we have to do is you have to use some math that we'll learn more about later to figure that out, to say, okay, so if I had X number of dollars today and I could earn, 9% interest on them, how much would that be worth in 5 years? And so here they've calculated out for us but haven't shown us how, but the present value of $100,000 to be received in 5 years is $64,993. And the present value of $9,000 received annually for 5 years is $35,000. So the total market price of the bond equals $100,000 in this case. Let's see, my slide's not wanting to advance. All right, sorry about that. All right, so here's how we do it. A corporation records bond transactions when it issues or retires, meaning buys back the bonds, and when the bondholders or if the bondholders convert the bonds into common stocks. Bonds can be issued at their face value. What that means is we actually sell the bonds to the investors at the same price that they're going to pay back at. That's face value. Or below face value, meaning we sell the bonds to the investors for an amount less than what they're going to get back. So if we sold the bond and the investor paid $970, but they were going to receive $1,000 at maturity, that would be called issuing the bond at a discount. Or we can sell them at a premium, an amount higher than the face amount. Bond prices are quoted as a percentage of their face value. So here's an example. Devon Corporation issues they issue 100 5-year 10% $1,000 bonds dated January 1st, 2014 at 100 or at 100% of face value. This is also called issuing it at par. Okay, so the entry to record the sale would be this. If they had $1,000 bonds, that means it would be $100,000. Their cash would go up, and their bonds payable would go up by $100,000. Then it asks us to prepare the entry they would make to accrue interest on December 31st. So for 12 months, it would take $100,000 times 10% times 12 over 12 or times 1, and that would be the interest expense, $10,000, and interest payable of $10,000. Then when they pay the interest payable would be debited $10,000 and the cash would be credited $10,000. All right, so that was issuing a bond at par. But here's what happens. Sometimes between the creation of the bond and the issuance of the bond, interest rates fluctuate, meaning the market interest rate fluctuates. But the bond rate, that stays the same, because once we create the bond issue, it gets printed on the certificate and it stays. So this bond in this example has a contractual interest rate of 10%. So if it's issued when the market interest rate drops to 8%, think about what's happening here. The person buying the bond is going to get 10% when all the other investments out there at the market are only paying 8%. That means that the person buying the investment is willing to pay a premium. They're going to pay more than the face value of the bond because they're getting a better rate. If the bond has a contractual rate of 10% and the market rate is 10%, then they're going to pay par or face value for the bond. And if market rates increase, meaning that you could make more buying another investment, then you're going to pay a discount. Read that helpful hint at the bottom. Bond prices vary inversely with changes in market interest rate. As market interest rates decline, bond prices increase. When a bond is issued, if the market interest rate is below the contractual rate, the bond price is higher than the face value. This is an important concept, and it's a fairly hard one. When I was studying to take my broker exam, this concept was really hard for me. Even though I'd learned about it, it was just really hard for me to wrap my brain around. So you need to spend some time just thinking about why that works and what causes it. And again, the logic behind it is, if I can get a bond that's paying 10%, but the best new investments out at the market right now are paying 8%, then the 10% bond is worth more than the new ones coming out. So I'll pay more, a premium. Conversely, if I have a bond paying 10% and I can get 12% at the market, then I don't want to pay full price for that. I want you to discount the price of the bond so it's giving me an effective rate of closer to the market rate, right? If I bought a bond that paid me 10%, but I only had to pay $900 for a $1,000 bond, then in the end, I'm getting a better return, right? Because I'm going to get $1,000 back at maturity, and that's going to give me an overall better return. So just remember this inverse relationship and really try to work on understanding why that is so. All right, so here's an example. Assume on January 1st, 2014, Candlestick Inc. sells a $100,000 5-year 10% bond at 98 or 98% of face value with interest payable, so that's called issuing it at a discount, right? So when they issue it, their cash goes up by 98,000. The discount on bonds payable is the 2% or 2,000, and the bonds payable is a full $100,000. So in essence, they borrowed $100,000, but they only received $98,000 in cash. The other two represents a discount. This is going to look on our balance sheet, it's going to look like this. Bonds payable of $100,000 less a discount on bonds payable of $2,000. So the interest payment is always going to be based on the face amount, even though they issued it at a discount. So they're still going to have to pay $100,000 times 10%, or $10,000 a year in interest. Multiply that by the 5-year life, they're going to pay $50,000 in interest, plus they're going to have to pay the discount, right? If you think about it, they only got $98,000 in cash, and they have to pay back $100,000. So their total cost of borrowing is $52,000. Sometimes bonds are sold at a premium. So if you were able to collect $102,000 by selling the bonds at 102, then this is how it would look. And if you're able to do that, then your interest payments would still be based on the face amount, 100,000 times 10%, or 10,000 a year, times 5 years, $50,000 total. But the bond premium is money you won't have to pay back. Remember, if you do issue at a premium, you get 102,000 in cash, but you only have to pay back the face value, or 100,000 at maturity. So the total cost of borrowing issuing the bonds at a premium would be $48,000. So the redemption of bonds, or the paying off of the bonds that were issued at maturity, were issued, let's see, this is the one, okay, so at face value. So they would just pay, the bond payable would go down, that would be the debit, and the cash would go down, that would be the credit. The basic concept of eliminating or redeeming the bonds from your books is to eliminate the carrying value of the bond, or the regular price of the bond, record the cash paid, and then you would recognize these are either a gain or a loss if they were done with a gain or a loss. A lot of bond redemptions there's no gain or loss. They're redeemed at face value or at the amount paid. All right. Here's an example. Assume that at the end of the 4th period, Candlestick Inc., having sold its bonds at a premium, retires the bonds at 103 after paying the annual interest. Assume that the carrying value of the bonds and the redemption date is $100,400. Principal of $100,000 plus a premium of $400. Candlestick records the redemption at the end of the 4th interest period. Here's how it would look. So their bonds payable has to go away, right? They have to get rid of bonds payable off their books. It's by debiting that account $100,000. They've also got to get rid of the premium because you just can't, when you get rid of that bond, you can't have any premium or discount left on your books. It's all got to be zero. Then the cash that gets paid is the $103,000 because they're saying it retired the bonds at 103. And so the difference between that is going to be either a loss or a gain. In this case, it's a loss. How can you know that? Well, first you can know because it's on the debit side, because that's what makes the transaction balance. And that's going to be an expense, a loss on bond redemption. The other way you can know is by actually figuring it out. Well, I got $103,000 in cash, but I only redeemed $100,400 worth of bonds. Again, here's what it will look like on the balance sheet. You'll see that the bonds always have their discount offsetting them. And there's all the short-term as well. So a couple other things to think about when we're looking at our liquidity or our ability to pay cash. What we're doing is we're trying to figure out what's the best way to put it? How easily can we pay our short-term debts? And so a common ratio used for doing that is the current ratio. We take the current assets and you divide it by the current liabilities. You can see this example with Toyota, that their current assets are 1.3 times greater than their current liabilities. That gives them a current ratio of 1.30 in 2011. This measures liquidity or the ability to pay off short-term debt. And then solvency, which is a related concept, the ability to pay off debt and have the cash sufficient to do what you need to do. There's the debt to assets ratio, total liabilities divided by total assets, and times interest earned, which is net income plus interest expense plus tax expense divided by interest expense. Sometimes that net interest plus interest expense plus tax expense is also known as EBIT, earnings before interest and tax are taken out. So if liquidity measures our ability to pay short-term obligations, solvency measures our ability to survive or pay our obligations over the longer term. All right. There's other types of financing that don't get shown on the balance sheet. They involve things like contingencies. The most common form would be, say, like a lawsuit. We know that we're being sued. We know that we may have to pay if we lose that lawsuit. That's not recorded on the balance sheet, but it's usually recorded in the notes in the financial statements. Just it says something along the lines of the company is currently involved in litigation and stands to lose a certain amount, whatever that would be, if we lose. All right, so now there's a couple other concepts to go over because we ran through those bonds pretty quickly, and there's a lot of questions probably in your mind, like, okay, so if there is a discount or a premium, what does that mean, and what do we do with it? So if we sell bonds at $98,000, but we have to pay $100,000 at the end, what do we do with that $2,000? And how do we account for it on our books? So the process of doing that is called amortization. And there's a couple ways to do it. The first is called straight line amortization, and the second is called the effective interest method of amortization. And so I'll kind of quickly go through that concept. So to amortize a bond's discount or its premium, what we do is we take the amount of the discount or premium and we divide it by the number of interest periods. So in other words, we're spreading that discount out over the life of the bond. So here's an example. Candlestick Inc. sold a $100,000 5-year bond, 10% for $98,000. So at a discount of $2,000. Interest payable is on January 1st of each year. Prepare the entry to accrue interest on December 31st, 2014. So there's the interest expense of $10,400. And you're like, whoa, wait, where's that expense coming from? Remember, any discount is going to cost us, right? Remember we looked at that when they got the $50,000 in the previous example and $2,000 of discount, then it said the total cost of borrowing the money was $52,000. So what we do is we figure out the amount that discount is going to cost us over the whole life of the bond, which is $2,000, and we divide that up by the life of the bond, which is 5 years in this case. So $400 per year of that discount is going to be recognized as an interest expense. So after 5 years, we'll have recognized the full $2,000. So there's the interest that comes about by the $100,000 times 10%, $10,000 in interest payable, plus $400 of the discount is being amortized, or a better way to say that is $400 of that discount is being recognized as an expense each year. Here's a bond amortization schedule using straight line amortization. Again, you'll see that they took this total amortization of $2,000 of discount, divided that by 5 years to get $400 per year. And you can see then that in column C that's recognized as the amount of discount. The interest expense is the interest to be paid plus any discount amortized. The difference between the face value of the bond and its unamortized discount is called the carrying value of the bond. So if it's a $100,000 bond and it has a 2% discount, that at issuance it's going to have a carrying value of $98,000. As we amortize that, you'll see the carrying value increases until it finally reaches the face value at maturity. So that's how you amortize a discount. Premium works the opposite way, right? So now with a premium, they've got $102,000, even though they only borrowed, or they're only going to have to pay back $100,000 at maturity. So again, their initial transaction is going to look like this. I'm sorry, no, prepare the interest expense. So their interest expense is $9,600. Why? Because they have a $400 premium on the bond that they're amortizing, and then they have to pay $10,000 in interest payable. So this recognizes that it costs them $2,000 less over the life of the bond to borrow that money. And so even though they're paying out $10,000 in interest, they only have $9,600 of it being expense. The other $400 is the portion of that premium that they've earned for that year. So there's an amortization schedule for a bond sold at a premium. You'll see the interest to be paid in column A, the premium amortization in column C, and then the difference between them is the amount of interest expense. The carrying value of the bond is the face value plus the premium. And then as we amortize the premium over the life of the bond, we end up with a carrying value equal to the face value of the bond at the end of its useful life. Not useful life, at the end of its, as it nears maturity. All right, the other method is what's called the effective interest method. So under the effective interest method, the amortization of the discount or premium results in interest expense equal to the constant percentage of the carrying value. For a lot of problems, they will give you this amount, but sometimes you have to calculate it. So here's the steps. Compute the bond interest expense, compute the bond interest paid or accrued, and compute the amortization amount. So here's an example. Candlestick Inc. sold $100,000 5-year bonds, 10%. That's the amount of interest printed on the bond on January 1st for $98,000. The effective interest rate is 10.53%. This can be confusing, but if you think about it, if they borrowed $100,000 and they only got $98,000, so this was done at a discount, then they're actually paying more than 10%. We're not going to get into how to calculate that effective interest rate, but for these type of problems, it will be given to you. At a later time, we may get into that. So prepare a bond discount amortization schedule. So what we do is we take the interest to be paid, that's column A, the interest expense, which is the effective interest rate times the carrying value of the bond from the previous period. So in the case of the first month or first period of the bond, you take the $98,000 carrying value from issuance and you multiply that times the effective interest rate of 10.53%, and that gives you the interest for that period. And then to find out how amount is the amortization of the discount, you subtract the interest to be paid minus the calculated interest expense. And so it's $319, that's column C. And then the unamortized discount is the unamortized discount from the month before minus any amount that was amortized. And then the carrying value is still the face value minus the discount. So in the end, we end up with the same thing, that we've amortized the whole discount, and that the carrying value of the bond is equal to the face value. It just does it in a different way. And again, the process is multiplying that rate that's given to you by there's the interest expense, there's the discount, and the interest payable. Here's an example of one done at a premium, $102,000. The effective interest rate is 9.48%. Why? Because if you borrowed money and you were paying back 10%, but you got $102,000, you got more money than what you're going to have to pay back, then in essence you're paying less than the full 10%. So again, the schedule looks like this. You take that effective interest rate, you multiply it by the carrying value, that gives you an interest expense to be recorded. You subtract that by the interest to be paid, and that gives you an amount of premium amortization. To find the unamortized premium, you take last month's or last period's unamortized premium and subtract them out any amount you've amortized. And then the carrying value is the face value plus, the face value minus any amortization. In the end, you'll be down to the face value equaling the carrying value, and the full amount of premium would be amortized. That's how you'd record it. Last thing, I know it's getting long. Long-term notes payable. So a lot of times when you have a long-term note payable, it's not like all these examples have been where you borrow the money and then the interest accrues, and then at the end you pay back all the money plus the interest. More often you have an installment loan where you're paying a certain amount of interest and a certain amount of principal each period. And usually the payment is the same each time. So they just want you to know how to deal with that and how to make a schedule of installments. So Porter Technology issues a $500,000, 12% 20-year mortgage note on December 31st. The terms provide for a semi-annual installment payment of $33,231. So what they want you to do is you have the principal balance, it's column D, and then each period you have an installment, and the installment amount is the same. That's A, cash payment. The interest expense is, in this case, it's the amount of principal times 6%. Really what it is the amount of principal times the rate of 12% times 1/2, or 6/12, because it's 6 months worth of payment. But that comes out to be 6% in this case. So you take the principal balance times 6%, that gives you $30,000 interest expense, and then the difference between the amount paid and the amount that was interest expense is the amount of the principal reduction. So for that first period, it's $32.31, and then the new principal balance will be the old principal balance minus any principal reduction. Then in the next period, you keep doing the same thing. You multiply the interest expense, or the rate, times the principal balance from the previous period, and then you subtract that from your total payment, and the difference is the amount that you paid to principal. So that's how you do a payment schedule for an installment loan. So when they first take the loan, cash goes up, mortgage payable goes up. Then their interest expense of $30,000, mortgage payable, that's the amount they're reducing of the principal of the loan, and that's represented as a cash payment for the total amount. And that's it. So this chapter, like I said, the bond concepts are usually confusing for people. It just takes some extra effort to wrap your brain around it and understand what it means. And everything else, people seem to, it's a little hard, but once they do it, it works out for them, because most of us deal with interest and liabilities a little bit in real life. So put the time and effort into understanding the bonds, and the rest of the chapter you should be able to do.